Okay, let's unpack this. We are diving deep today into the latest financial results from Lululemon. Specifically, their first quarter of fiscal 2025, which wrapped up on May 4th, 2025.
That's right. We've got the official earnings release, the supplemental commentary, even their infographic, basically all the raw material.
And our goal here is pretty simple. Cut through the jargon, the numbers, and really understand what happened this quarter. Where did they grow? Where were the challenges?
And what are they signaling for the rest of the year? We're aiming to give you that shortcut, so you're really up to speed on Lululemon right now, based on what they've told us.
Exactly. Let's jump right in.
Okay, so the headline numbers. Total net revenue, $2.4 billion.
Which is up 7% compared to last year, or 8% if you adjust for currency fluctuations, constant dollar basis, they call it.
Right. And diluted earnings per share, EPS, came in at $2.60. That's a slight bump, 2% from $2.54 last year. So growth on those top metrics.
And this is where it gets interesting almost immediately. That 7% total revenue growth is paired with a comparable sales increase of just 1%.
Yeah, just 1%. And that comparable sales figure, that's really key.
So explain that contrast. A 7% jump overall, but only 1% in comps. What does that signal right off the bat?
Well, total revenue counts everything. New stores opened, maybe acquisitions, the whole lot. Comparable sales, though, that's about the performance of the established business stores open at least a year. Plus, their e-commerce. It's apples to apples with last year.
Okay, so the big difference suggests that the brand new stores are doing a lot of the heavy lifting for that 7%.
Precisely. It suggests a good chunk of that top-line growth is coming from expansion, adding new locations rather than, the existing stores or website selling dramatically more than they did last year. The underlying growth in the core business looks much slower.
That makes sense. So let's follow that thread. Where is this growth actually happening geographically? Because the reports really break this down.
They do, and it paints a really divided picture. Let's start with the Americas. Still their biggest market, right? 71% of revenue this quarter. Net revenue there was up 3%, which sounds okay, maybe a bit soft, but, and this is the kicker, comparable sales in the Americas decreased by 2%.
Wait, decreased? Not just slow growth, but actually down 2% in their main market on a comparable basis.
Down 2%. That definitely jumps out. Now, contrast that with international. That's where the real action is.
Okay.
China mainland. Net revenue absolutely soared, up 21%. And importantly, comparable sales there were up a healthy 7%.
Wow, okay. 21% total growth in China versus 3% in the Americas, and positive comps versus negative comps. Big difference.
Huge difference. China's now 16% of their total revenue, and they're still opening stores. There are 3 new ones just in Q1.
And then the rest of world segment.
Also strong. Net revenue up 16%, comparable sales up 6%. That region's about 14% of the total pie.
So this geographical split is really the core story on the revenue side, isn't it? You've got this booming international growth, especially China, but real softness, even a slight decline in comparable sales in their biggest market, the Americas.
Exactly. And if you think about their commentary on the dynamic macro environment, well, this looks like Exhibit A. It suggests maybe some consumer headwinds or just a tougher market in North America.
While the international expansion strategy, particularly China, is clearly firing on all cylinders and driving growth.
Right. It raises that strategic question, doesn't it? How much can international keep offsetting that core market softness, especially since some of that international growth is from new stores, not just comps?
Yeah, that's a key point. Though, looking at their infographic, it seems like growth was pretty balanced across how people shop stores versus online and what they bought.
Yeah, that's true. On a total basis, store revenue was up 8%, digital up 6%, pretty close. And across the product categories, women's was up 7%, men's up 8%, accessories also up 8%. So fairly even growth across those segments in total dollars.
Okay, let's switch gears a bit. Profitability. How did all this translate to the bottom line? Gross profit first.
Gross profit was up 8%, hitting $1.4 billion. And the gross margin actually improved. It went up by 60 basis points.
60 basis points, so 0.6% to 58.3% total. What drove that improvement?
Well, the commentary points mainly to better product margins. So think lower cost to make the goods, maybe some higher average prices they were getting, and fewer markdowns. That helped by about 110 basis points.
Okay.
But it was partially offset by things like slightly higher freight costs and some fixed cost deleverage in production. But net, the margin on the actual product improved.
Right, so more profit directly from the stuff they sold, but You look further down at income from operations, that only increased 1%, just 1%, to $438.6 million.
And crucially, the operating margin actually decreased. It went down by 110 basis points to 18.5%.
Hold on, gross margin goes up 60 basis points, but operating margin goes down 110 basis points. How does that work?
That's the SG&A story. Selling, general, and administrative expenses, basically the costs of running the business.
Okay.
Those costs grew faster than revenue. SG&A as a percentage of revenue jumped from 38.1% last year to 39.8% this quarter.
So they spent more on overhead, marketing, corporate stuff relative to the sales coming in.
Exactly. The report mentions corporate SG&A, depreciation from investments, amortization, even foreign exchange impacts, pushed that number up. So even though they made more profit on each item sold, the overall cost of running the entire operation, including all those growth investments, increased at a faster rate than sales.
Which squeezed the operating margin. That makes sense. It's the cost of that expansion and investment showing up.
It is. It's the bigger picture cost structure. They also noted a couple of smaller things dragging on profit too, like lower interest income, because they had less cash on hand.
We'll get to the cash in a second.
And a slightly higher tax rate. All these things combined meant that net income, the actual bottom line profit, was slightly down compared to last year, $314.6 million versus $321.4 million.
So revenue up, EPS up slightly, but actual net income dollars down. The EPS increase must have come from fewer shares outstanding then.
That's right. Primarily due to share repurchases, buying back their own stock.
Okay, let's talk about that cash situation. The balance sheet shows cash and cash equivalents dropped quite a bit. Went from $1.9 billion at the start of the quarter down to $1.3 billion.
Yeah, that's a $600 million drop in one quarter. Where did it all go?
The cash flow statement tells the story. Firstly, cash from operations was actually negative this quarter. They used $118.9 million. Last year, operations provided cash.
Interesting. So day-to-day business used cash instead of generating it in Q1.
Right. Then, investing activities. They spent about $107 million on capital expenditures, CapEx, building things, technology, etc.
Okay, typical investments.
And the big one, financing activities. They used $468 million there, and the report says that was primarily for those share repurchases, buying back stock.
Okay, so cash used in operations, cash spent on investing in the business, and a big chunk returned to shareholders via buybacks. That explains the lower cash balance.
Exactly. Now, another balance sheet item that caught my eye, inventories.
Oh yeah, what about them?
They increased significantly, up 23% compared to last year, reaching $1.7 billion.
23%. Wow, that's quite a jump in inventory.
It is. On a unit basis, so the actual number of items, inventories were up 16%, still substantial.
So the dollar value grew faster than the unit count. What do we make of that inventory build? Is it planned? Like, are they stocking up for growth for new stores?
That's the big question, isn't it? Is it intentional stocking for future demand and expansion, or could it be a sign that maybe things aren't selling through quite as quickly as they expected, particularly with those softer Americas comps?
Yeah, that higher dollar growth versus unit growth could mean they're holding more expensive items, or maybe costs per item are up. Something to watch.
Definitely. And they did mention those capital expenditures were for things like distribution centers, new stores, tech investments that support growth, which might require more inventory on hand too.
True. It could be part of the plan. So what did management say about all this? Their outlook?
Well, the CEO, Calvin McDonald, sounded positive, talked about growth across the board channels, categories, markets, including the U.S., actually. Mentioned guests responding well to innovation activations.
And navigating that dynamic macro environment, right? Using their finances to play offense, invest in growth. Standard CEO positive framing.
Pretty much. And the CFO, Megan Frank, echoed that. Pleased they hit Q1 revenue guidance, said Q2 was off to a decent start, focused on strategy, discipline, delivering results.
So confidence expressed. What about the actual numbers they guided for? Q2.
For Q2, they're forecasting net revenue between $2.535 billion and $2.560 billion. That translates to about 7% to 8% growth year over year.
Okay, similar pace to Q1's total growth and EPS.
Projected EPS for Q2 is $2.85 to $2.90.
Right. And the full year, fiscal 2025.
Full year revenue guidance is $11.150 billion to $11.300 billion. Now that's stated as 5% to 7% growth compared to fiscal 2024.
5 to 7% for the full year feels a bit slower than the 7-8% they saw in Q1 and expect in Q2.
But there's that 53rd week factor again. Fiscal 2024 had an extra week.
Right, the extra week comparison issue.
Exactly. So they note that excluding the impact of that extra week last year, basically comparing 52 weeks to 52 weeks, the projected growth for this year is actually 7% to 8%.
Okay, that makes more sense. So on a comparable time frame, they expect that 7–8% growth momentum to continue through the year. It's a clearer picture.
It is. And of course, they include the usual caveats about forward-looking statements, risks, macro shifts, competition, the standard stuff.
Naturally. Always uncertainties.
So let's try and wrap this up. Key takeaways from this deep dive into Lululemon's Q1. Solid top-line revenue growth, yeah, but really fueled by international expansion, especially a booming China.
Definitely. While the core Americas market showed softer comparable sales, actually dipping slightly negative.
They managed to improve their gross margin, getting more profit from the actual products, but
Operating margin got squeezed because those SG&A costs, the investments in running the business and expansion, grew faster than the revenue came in.
right. And we saw that big jump in inventory, up 23% in dollar terms, raising some questions. Plus, a significant drop in cash, driven by operations, CapEx, and quite a bit of share buybacks.
And management expressing confidence, guiding for continued growth around that 7–8% mark for the full year on a comparable week basis.
So putting it all together for you, the listener, Lululemon seems to be executing well on its global growth playbook, especially in China, and managing product costs. But they're also investing heavily, seeing some clear softness in comparable sales in their biggest market, and inventory levels are climbing.
It really feels like they're juggling those two things, aggressive international expansion against a more challenging domestic environment.
Which leads us to a final thought for you to chew on. Given that significant 23% increase in inventory and the slower, even slightly negative, comparable sales growth in the massive Americas market, how does Lululemon strike the right balance? How do it keep funding that crucial international growth while carefully managing potentially swelling inventory levels if that core market demand stays sluggish?
Yeah, managing inventory while still fueling growth in the right places. That's going to be key for them going forward. It's a tricky balancing act.
Absolutely. Something to keep an eye on in the coming quarters. Thanks for joining us for this deep dive.